Is your fixed rate mortgage ending soon? Don't panic, but don't ignore it either. Today we're breaking down what happened when your deal ends, what your options are, and how to make the smartest move before it costs you money. When your fixed rate expires, whether that's a 2, 3 or 5 year fixed rate, you don't lose your mortgage, but it does change. Firstly, you'll automatically roll on to the lender's standard variable rate, which is usually higher and obviously not fixed. In 2025, that could mean rates of 7% or more, which can see your payments significantly increase to what you're used to paying. Before that happens, you've got a few key options. Let's break them down. Option 1 is remortgaging to a new lender. This can typically be best if you want the best rate or more flexible terms than your current lender provides. It'll involve new affordability checks, a property valuation and legal work, and it can take up to 2 months, so act early. Secondly, you could do a product transfer with your current lender. This is best if you want something quick with no legal faff, there's no credit check or valuation, but it may not be the most competitive rate, however it is easier. Option 3 is moving on to a tracker or an SVR for a temporary period of time. It's best if you expect rates to fall and want flexibility, although there is a risk that rates could rise and your payments go up. You can remortgage later on and usually without penalties. Here's the crucial bit, it's all about timing. Most lenders let you lock a deal in up to 6 months early before your rate ends. This gives you peace of mind, and if rates drop you can always update your application. So don't wait until the last minute. Many homeowners do and they get caught out. Even a month on the SVR can cost you hundreds and hundreds of pounds. So let's talk strategy. Firstly, review your budget. Know what your new payments could look like in today's rates. Speak, of course, to a whole of market mortgage brokers like yourself. We can help with search across lenders and also help with timing. Watch rate trends, as rates can change weekly, but don't just assume they'll drop. Check for early repayment charges and see when you need to act. And make sure you plan around life events, such as moving, going part-time or having children. A slightly higher rate with no tie-in period might be more expensive than a 5-year fixed, but actually if it gives you the flexibility to review again in 18 months, that could be crucial. Here's 5 crucial mistakes that people make. Firstly, waiting too long to act. Only checking with their current lender, ignoring product fees that a lender may charge, assuming the lowest rate equals the best deal, and not factoring in life plans. Don't just sit there and let it happen. Going onto the SVR can cost you thousands of pounds. If your fixed rate is ending, it isn't a problem, it's an opportunity to make a smart move. Get ahead, compare your options and protect your finances. If you've got any questions, drop them in the comments. And like this video if it helped, and subscribe for more UK and property finance content. See you next time.